Hi guys, how are you? This is Ibad Rahman. Welcome to my channel once again, Finico. Today we're going to speak about another important concept in the field of finance, being leverage. And here in this concept will I be taking you forward to the measurements of leverage, and is leverage a good or a bad thing, and in what scenarios and situation could leverage be your friend, but at the same time it can also go on to be your foe. However, let's go on and start with a very simple introduction and the definition of leverage. So leverage, what does a leverage mean? Leverage is a fixed cost which is inputted on you, the cost which you would have to pay over a period of time until the entire cost is expunged. What could be the examples of it? Say for example, one of the easiest of all, that you have taken a debt from a financial institutions, you have taken a debt from a bank. Now you would have to pay just not the principal amount, but also an interest payment. Now that interest payment could either be a fixed rate, an accord, which could, or a covenant, which could be signed between a party who has taken a loan and the party who is giving a loan, the lender and the borrower, right? And that could be based upon a fixed rate, or it could be based upon a variable rate in which you have the floating rate, such as either the LIBOR or the EBOR, which is your London interbank offering rate, or your EBOR, which is European interbank offering rate, plus your premium. And premium basically is your credit risk, which is which is charged towards it. So that is basically what you see through is a fixed cost, in which what we say it's leverage. However, leverage could also be termed that, say for instance, that you are residing in an apartment and you have rented that apartment out. Now that contract which you have gone on to sign an accord for 1 year, that amount needs to be paid on an annual basis. The frequency could either be on a quarterly basis, or on a monthly basis, or on a semi-annually basis, or an annually basis, but there's a fixed cost towards it. So holistically speaking, I hope that I have gone on to derive the definition of leverage. It's basically the fixed cost which you have to pay over a period of time until the entire cost is expunged, right? The next is you have got your business risk. Now business risk is your sales plus operating risk. Now what does this mean? I mean, in any business there would be a sales risk. A sales risk basically means is that you have got to generate those revenues, be it year over year, year to date, month over month, and those revenues being higher than what it was during the latter phase, which is no reason why what you would see through that at the earning results and the earning reports of the many institutions or the corporations, that the stock price goes up and the stock price goes down, because the actuals have either gone on to beat the estimates, or the actuals have not gone on to beat the estimates. So there is a variation in that. You then have got your operating risk, and what operating risk could be said that there is a risk with respect to the operating fixed cost, which either increases or decreases, which goes on to either amplify your operating earnings, which is your EBIT, which is your earning before interest and tax, or could be acted as a detriment towards the operating earnings. And you have got your operating cost. I mean, the examples could probably be your sales, general and administration, the wages employees going high or going low. So those basically being your operating cost. Now we have got your financial risk, and just by the word financial risk you probably have already got it, that it is based upon a debt. Say for instance that you are servicing the operation of your business, of your corporation through debt, and you have to pay that debt over a period of time. That is what your financial risk is. Now, in terms of leverage, one of the two most prominent way of calculations, which is your degree of operating leverage and degree of financial leverage, absolutely crucially important in terms of the concept that you can go on to use these formulas and see through, oh well, I have these leverages. Is it actually I mean, has my reward to risk ratio gone high? Am I being better off with this leverage, or am I not? And in some instances, or probably most of the instances, if the leverage is used adequately and responsibly enough, you would see through that uh, that the reward to risk ratio is high, and that goes on to contribute by the return on equity also being high, and basically your return on equity being your net income divided by your equity, your total equity. And your formulas for your degree of operating leverage is your Q into P minus V divided by Q into P minus V minus fixed cost. So your Q is your quantity, your price is basically your sales, okay, I mean for how much have you sold it, minus your variable cost, and your FC basically being a fixed cost. And this formula is mostly used in, you have guessed it right, in a manufacturing company. Those very companies which go on to produce commodities, goes on to produce finished goods and then sell it off. The other formula can also be calculated on the basis of your sales. What is your total sales minus your total variable cost being in your numerator, divided by your sales minus total variable cost minus fixed cost. Now we will be doing an example of this in order to shed more light towards this concept. Now then you have got your degree of financial leverage, and just, you know, as I've gone on to define you what financial leverage is, financial leverage is basically your the debt which you have gone to take in order to service the operation of the business. How you going to calculate is your earning before interest and tax, basically your operating income, divided by your EBIT, earning before interest and tax, minus your interest expense. Last but not the least, you have got your degree of total leverage, which is simply the multiplication of your degree of operating leverage into degree of financial leverage will give you a degree of total leverage. Now this is all theoretical concepts, but however, in order to give you more lights about this concept, I will be doing 3 equations over here on the basis of DOL, DFL, DTL, and one of the bonus being that how can I go on to prove that actually having a leverage, servicing your business operations by leverage could probably do you more good than harm. But terms and conditions definitely apply. It really depends what kind of an interest payment would you have to pay, what kind of a debt you have gone on to take, and at the same time what is the ratio between your equity and your debt. I will see you in the next slide. Guys, so here I've gone on to put like, you know, simple equations for you to understand. So basically the company being a bison company, you know, the animal bison, so that's the name of the company, and what it has gone on to produce in terms of the quantity is 5,000 units. The sales has been 75, for example, let's just take the currency being USD, all right, so $75 per quantity. Your fixed cost is 70,000, and 70,000 is like the total accumulation cost. So in order to produce 5,000 quantity, the fixed cost is 70,000. You have got your variable cost, which is set at 50,000, right? This is not 56, apologies. It's 50,000, sorry, 50 USD 50 per quantity. And then the very formula, as we have gone on to say that when it comes to the manufacturing industry, you know, it is your Q, your quantity, into price bracket, you know, bottom mass, into price minus variable cost, divided by quantity into price minus variable cost minus your fixed cost. The other formula being your sales minus your total variable cost divided by sales minus total variable cost minus your fixed cost. You input all of that into equation, and I did that because, you know, I want to expedite this process. I do not want this video to be super long as well. So you basically get your degree of operating leverage being 2.27. Now with now that's your DOL. Now with your DFL, that has to do with the debt what you've taken. This is one of the I would say the juxtaposition what you can go on to take. Whenever there is a debt, whenever you've taken a loan from someone, that is, and you have to pay an interest payment towards it because it's an interest expense, it should trigger into your mind, oh, it is a DFL. And whenever there is no debt, whenever there's, you know, whenever there's variable cost, for example, because when it comes to your debt, there is no variable cost. Yes, it could be said that, well, the fixed cost could be altered, but that's for after a period of time. Or even that variable cost, the floating rate plus your premium. Sometimes your floating rate, which is your LIBOR and EBOR, does go on to change frequently, but your premium is mostly the same throughout the rest of the contract. So then if you look at the DFL, which is your degree of financial leverage, you would find out that the quantity is 5,000. You will see that the operating income is 55,000 and the interest expense is 20,000. Now the formula being over here is your operating income, your EBIT, divided by your EBIT minus interest expense. You sort that out. It's basically 50,000 divided by 55,000 minus your 20,000. 20,000 is your interest expense over here, 20k. I did not have any space, that's the reason why I wrote 20k. You get the figure of 1.57, that's your DFL. And the most easiest formula in order to find the total leverage, if you would like to find out, that's basically your degree of operating leverage into degree of financial leverage, which will give you a figure 3.57. So I really hope that the concept of DFL, of DOL and DTL is clear. Now I have to also go on to provide you one really essentially important topic. If you remember that I said that I will be speaking about return on equity as well, and show to you that how come return on equity will actually be higher if you have a leverage rather than if you do not have a leverage. So that would be on our next slide. Right guys, now last but not least, the concept over here that I basically said on to you that I will prove that how you can actually be leveraged and have a higher return on equity. This being the question. So over here what I've taken is your equity being your 1 million, and equity basically means how much money you own completely. That is your own money. You do not have to pay any interest payment, you do not have to pay any kind of interest cost towards it. Like there's nothing other than the inflation, but inflation is also on debt. But as we say, inflation is a hidden tax as well. Then from your equity, you have got your operating income. Your operating income being your EBIT is 500,000. From that you've got your tax, which is 40% of the 500,000, which will give you a figure of 200,000. You subtract 500k minus 200k, you get a net income 300,000. Now your return on equity is 0.30 or also 30%. Now how do I get that? The formula of return on equity is basically your net income, okay, which is your 300,000 divided by your equity. Equity is your 1 million. You do the math, you get 30%. Now if we take the same concept but we twitch it a bit, so here you have equity being at 500,000, over here it was 1 million. However, you have got the debt which is 500,000 and the capital is 1 million. So more or less in terms of your operation scale, how much money which you can use in order to see through that your business runs is the same. You've got your 1 million over here, you've got 1 million over here. The difference is one part has been equity, the other part has been debt. All right. So you've got your EBIT, which is 500,000. We're keeping the concept same. But obviously, because you have gone on to take a debt, you will have to pay an interest payment towards it. So the interest expense is 15%. When you compute 15% from 500,000, you get 75,000. So 500,000 minus 75,000, you get 425,000, which is earning before tax, because you would have to pay tax for it. Then you get taxes, basically your 40%. You get a figure. I believe it's probably around 175,000. I might be wrong, but anyways, I did the math. So it's for 425,000 minus the figure. Your net income, however, is 255,000. Now, that same concept what we apply over here, you basically take your net income, okay? Your net income being your 255,000 divided by your equity over here being 500,000. We're not going to take 1 million, and you get a figure of 0.5151%. So this by itself just goes on to simply prove that you can actually have a higher return on equity. You can have a high return on equity despite being leveraged. And return on equity is actually good because it goes on to signify that how much income you're actually generating by using your equity. But at the same time, it should also be considered from the point of view from the aspect of leverage. Right now, what you see is the leverage is 50-50 percentage, leverage and debt. And as long as if you are producing a net income which is solid, that's good. But if the net income decreases, or if there is a net income which is a loss making company, which is in the red line, which is negative, that is where the trouble comes. And we will be speaking about different kinds of leverages other than this, I mean, be it the debt or debt by equity, the debt by capital, the debt by asset, the financial leverages. We would be speaking about that in detail, but I just wanted to give you basically a quick snapshot about what leverage means, about what leverage is. We basically spoke about leverage being a fixed cost which you need to account for, and you need to pay for it until that very expense or the cost is expunged, right? The different kinds of leverages you have, the degree of operating leverage and the degree of financial leverage, you multiply both, you get your degree of total leverage. What is your business risk? Is the combination of your sales risk plus your operating risk. What is your financial risk? Whenever it comes to finance, it only has to do with debt. Whenever it comes with your operating risk, it has to do with the fixed cost with respect to your operating expenses, right? Which could obviously go high or low. It really depends upon upon the particulars, being your sales, general and administration expenses, your wages, employees, printing and stationery whatsoever. And yeah, the return on equity being high if you have if you are leveraged, and the return on equity being low if you're not leveraged. I sincerely hope that this presentation about the measures of leverage has gone on to help you. And if there are any questions whatsoever with respect to it, please go on to comment. Do not forget to like, subscribe, and share as well. And I will be seeing you next in another part of the video. Thank you so much. Wish you all the best. Cheers.